All right, this is the next installment in our real estate myth busting series, and we're tackling, easy for me to say, boy, it's too early in the morning. We're tackling one of the biggest ones that we hear all the time, which is that real estate is your biggest financial investment, the largest investment of your life, and the best wealth building vehicle for the middle class. Now, the opposite side of that argument is real estate has barely outpaced inflation for most of recorded history, and it's not the investment that everybody tells you it is. We're going to unpack both of those, show you why both of those are wrong, and what the real benefit of owning real estate is, how you're actually earning money in real estate. And it's not from appreciation, which is what's mostly hyped to you on the news as how you're making your money in real estate, and walk you through the decision tree about whether owning real estate is truly a great investment for your family, and give you some other ways at the end to think about real estate, some other benefits that you might want to grab for your family, regardless of the investment benefits. I think by the end of this episode, we will paint a picture for you that the investment side of real estate is the cherry on top of all the other good things that real estate has to offer. Or maybe where you live in the country, you decide real estate isn't the right investment for me, and I'm going to dump all my money into the stock market. That decision is yours. We're just here to help frame your thinking about it. Welcome back to the Informed Homebuyer Podcast. As always, I'm your host, Rich Curtis, and I have my co-host with me, Dave Miller. Hopefully he can talk better than I am this morning.
Oh, I'll try, Rich. Thanks for having me. Looking forward to this episode.
Yeah. I mean, I feel like what we try to do here is to help you guys pick the signal from the noise, give you a little real talk in real estate. Maybe that's what we should have named this instead of the Informed Homebuyer Podcast. You guys can vote in the comments down below. You want us to change the name? But let's give some historical context. Over the 80 years of recorded real estate statistics that most of us are working with, real estate has only outpaced inflation, figuring on an average of 3% inflation. Real estate, in terms of price appreciation, has only beat inflation for about 20 of those years. We're looking at about 24% of the time this asset has beat inflation. Now, if you are purchasing appreciating assets, your first goal is to beat inflation, right? Cash sitting in the bank is going down in value. Cash and appreciating. I told you guys can't talk today. Appreciating assets is hopefully going up for you, but it has to be going up at more than 3% for it to be of any value. I've just told you real estate's only pulled that off for 20 out of the last 80 some odd years, 24% of the time. If you go back 135 years where you have to massage the data a little bit to get it right, it's more like 15% of the time. And that's what these online, investment guru types are yelling into things. Don't buy real estate, put all your money in the stock market, yada, yada, yada. It doesn't outpace real estate. Well, it's probably because they're trying to sell you their class on how to put your money in the stock market. And they're not really giving you a nuanced take on what is actually happening there. You earn all of your money in real estate due to leverage, not appreciation. And we're going to talk through how that is. Dave's got some personal stories of leverage and how that works for him. And then we'll take our $500,000 scenario and go through how that plays out in terms of leverage for you. But Dave, just looking at the arc of your lifetime, purchasing homes and looking at that leverage component, can you talk a little bit about how much asset you've been able to control versus how much money you're putting into it?
Yeah, Rich. And when we talk about leverage here, I think it's fascinating to me and always has been to think about. And I have buddies that are financial planners, and we've had debates over this. And I have one guy that's actually doesn't own a home right now. He used to own a home, and he argues that, that's the best bet. But it's simultaneously, which is a separate side story, is like, he rents and he's constantly dealing with the hassles of renting, and he's acquired a bunch of stuff and has to move. So he forgets to bring in all those, points that, renting isn't necessarily very glamorous. But when we talk about leverage, Rich, and I can go back, 30, almost 30 years now, 27 years, being fascinated with being able to buy a house. And at the time, the average house was, $200,000, 250 purchase price, and I also promote this with some of my clients that have 20+% to put down, is you could do both things. Is you're leveraging, you don't have to put 20% down to purchase a home. You could put less money down, and you can do a balance mix. You could be invested in the market, also buy real estate. But when we talk about leverage, it's fascinating. You buy a $200,000 house and you put 5% down. That's 10,000 out of your pocket back then, plus closing costs, maybe 15,000 out of pocket. In 2 years, that $200,000 asset appreciated by 20%. So that was worth $40,000 more than what I paid for it, with with literally $15,000 out of my pocket.
Yeah.
There's
Amazing.
other pieces to the other components to the story, but there's nowhere else I think that you can just get that leverage and build that leverage that also gives you some flexibility in terms of over time, to continue the story, live in that house for 6, 7 years, pull money out because it continued to appreciate and outpace inflation. But pull some cash out of that property in a refinance simultaneously, luckily, timing, lower my interest rate, keep my payment a little bit just a little bit higher by pulling enough money out to go leverage another piece of real estate and have that be my 5, 10, 15, 20% down on that next piece of real estate, whatever you're comfortable with. So now you got two assets working for you with, if I put 10% down on both properties, you're looking at, 20,000 plus, appreciation, 40,000, 60,000 on $700,000 worth of real estate. That's
Yeah.
if that appreciates at 5%, you're talking $35,000 a year based on your 40,000 out of pocket. Pretty good.
Yeah, and that's the math that is important here as to why the leverage is where you earn the money. So if you have $100,000 asset that you purchased for $100,000 and it goes up 1%, you got your $1,000 for your $100,000 investment. You earned 1,000 out of 100,000. Let's say Dave did that. Now let's say I bought that $100,000 asset for $10,000 down. It goes up by 1%. I got my $1,000 for my $10,000 investment, right? Who did better? Take our $500,000 case, right? So 3%. So we're going with inflation. If my house just kept pace with inflation, I bought a $500,000 house. That's the median in Placerville, median in the Sacramento area, not the median in Folsom where Dave's sitting. The suburbs of Sacramento have different price points, but we use 500,000, makes the math easy. 3% is $15,000, right? So if I bought it for 500 grand, I made $15,000 for a $500,000 investment. If Dave bought it for 15,000, 20,000 out of pocket, say 20,000, he made 15 grand on 20,000. The return on investment for Dave is massive compared to the return on investment for me. He earned all of the benefits of the investment potential of real estate by leveraging. I earned almost none of them because I dumped all my money into my home. Now, not to go on a side quest here, and we should do a completely other episode on this, but this is why neither Dave nor I, and we have this conversation offline all the time, ever recommend paying off your home early or paying double payments or any of that crap. And one of the biggest financial influencers on the planet, Dave Ramsey, constantly hammers people with paying off their home. I think Dave Ramsey's great. His book, Financial Freedom, changed my life. If you're looking to pay off debt and earn your first $100,000, that you can invest, Ramsey's your guy. Once you've got $100,000 invested, don't listen to another thing Dave Ramsey says the rest of your life. And certainly don't listen to him about paying off your house. Once you pay off your house, you are receiving the nominal return of the market, which, as I've told you, all but 24% of the time is just in keeping pace with inflation. You're not earning any money. You earn all the money you earn in real estate via this leverage, and you take away the leverage component by paying off the house and making double payments. Also, all that money you could use to make double payments, to Dave's point, you could use to put into the market instead. And now you're getting the benefits of home ownership and stock investing over time. So don't pay off your house. That is a surefire way to negate all of the benefits, essentially financial benefits of home ownership.
Yeah, Rich, and I've been doing this a long time, and oftentimes I've had clients that own multiple properties, and not all necessarily residential. Maybe they bought residential and they 1031 it, or they cashed that out and they bought other investments with that real estate as it, appreciated over time. But the common theme is, hey, how did you do that? What is, one gentleman said to me, OPM is how you make money. And I'm like, OPM? He's like, yeah, other people's money. So you're leveraging. And when we talk about other people's money, we're talking about banks. We're talking about borrowing money at a low fixed rate or whatever that rate is. And that's a fixed rate. and then you're leveraging that asset based on a fixed rate. And we talk about that all the time, Rich, in terms of, first time home buyers or anyone that's buying a house. If you have a mortgage, the principal and interest, if you do a 30-year, and I'm a big proponent of the 30-year mortgage, I don't really think there's a significant benefit in, ARM loans based on the risk reward, but for that 30-year time, your principal and interest is not going to change. That is
Yeah.
fixed. And over time, if you have a principal and interest payment of, I'll just say $2,000, and your rent at the time is $2,000, in 10 years, you're still paying $2,000 principal and interest. A good portion of that payment now, a much higher portion is going towards principal, but that rent that you were paying at $2,000 is most likely, keeping up with inflation, is probably 3,000 plus. And so, that's the piece that, that you really have to look at when making these decisions.
Well, and that's the second benefit here. So the investment potential, the way you actually earn money with your real estate is via the leverage, not the price appreciation. So you can kind of set that part of the argument aside. But the other thing is what Dave's talking about, a hedge against inflation. You lock in, as long as you're not making stupid decisions with loans, as long as you're taking a 30-year fixed instrument loan, you are locking in the largest line item on your monthly budget, which is your housing cost. And you're locking that in essentially forever. If you don't get wandering eyes and want to go buy a bigger, better house, you can lock that in, essentially forever. Now, what can change? Your homeowner's insurance can change and your taxes can change. Although here in California, you do have your Prop 13, so they can only change whatever that is, the 2% a year if you don't pull permits and do a big remodel. So you've got a pretty good hedge against your taxes changing, at least in our state as well. It's not the same everywhere. But the biggest chunk of your line item, on your budget is fixed for life. So you get the leverage returns and you get the hedge against inflation. And we're going to dive deeper into some of the other intangible benefits of homeownership. Before we do, let's pick apart the argument a little bit more about why it's not a great investment. So the first part of that argument is, hey, it has only barely outpaced inflation for most of the arc of history. They're right. They're not wrong. They're just leaving out the part where you are getting your leveraged returns, or leaving that part of the math off in that argument. The other part of the argument I hear all the time is when you are figuring out your overall returns on real estate, you're not factoring in all the shadow costs of ownership. And Dave, you've owned a lot of houses. I've owned houses. They are not cheap to maintain. Just talk us through a quick basic list of what you have to factor in when you think about your overall returns. If my overall return on a home is 500 grand, well, what do I have to kind of mentally deduct to kind of get closer to my real return?
Yeah. Well, and I think it's anything, whether you live in a home or you're renting out, there's maintenance costs, there's costs, utility costs, things that maybe, and I always try to compare, what do you pay when you rent versus what do you pay when you own? When you rent, you're often paying almost all those same utilities. But when you own, there's, and there's a separate piece to this, but there's, a home is naturally going to, over time kind of not depreciate in value, but in quality, right? Like, you're going to get some dry rot, you're going to get some, the mechanicals are going to age over time. So those things, if you maintain those properly, you could extend the life of those quite a bit. But there's always, what we talk about is hidden costs, things that pop up that you don't pay for when you rent. So you need to factor those in. But if you're reasonable about that and you factor that in on a monthly basis, and you include that in your cost and your cost basis, you'll be fine. It's when you don't prepare for that and something pops up and you got a, an $8,000 ticket that you weren't prepared for.
Yeah, but if you were going to compare your stock returns to your home returns, it is valid to say, well, deduct the cost. If you're going to keep it 30 years, you're going to put at least one roof on the place. You're going to put at least one new hot water in the heater in the place. You're going to put one new HVAC. None of these things last more than 30 years. The taste of what interior fit and finish look like are going to change. You're probably going to do some flooring and some paint, maybe even kitchen and bathroom remodels. You can factor all of that in and take that off of your gross real estate returns and kind of adjust that down. And when you do that over the sort of arc of a 30-year ownership for a home, and then you compare that to your realized stock returns, if you were to have 30 years ago put 100 grand in the market and just let it ride, or you were to have bought a $500,000 house for 100 grand, so you've put 100 grand investment in each. then your stock market investment, assuming no world and global collapse, will have probably returned 300 or 400 grand more in 30 years than your real estate investment. So if we want to talk about just dollars and cents, those people yelling at you from the microphone that have no industry experience or degrees, but they're really loud and they have good video editing, they're not wrong. They can stand on the fact that they're telling you a fact. What they're failing to take into account is that you can't live in, raise children in, or control your monthly budget via your stock investments. So, and also they're ignoring the biggest piece of the benefit of home ownership, the financial benefit outside of leverage, which is the behavioral component, which is most people are not inclined to be exceptionally diligent and disciplined about stock investing. But if you don't want to get kicked out of your house and have it taken away by not paying your mortgage, most people pay their mortgage every month on time. And so talk a little bit about that, Dave, because we've both had a lot of clients over the years tell us they're going to do this, that, and the other with their money. And we get a peek into their finances 7 years down the road again when they're going to buy another house. And it usually looks mostly what?
The same or not as good as what it was, right?
Yeah,
And
the same. Yeah.
yeah, and I, and it brings up that other piece, Rich, that we talked about here. And, folks will call me all the time and say, oh, well, I'm going to go with this 30-year fix and I'm just going to make an extra $1,000 a month payment. And, the Dave Ramsey thing, and I'm going to have your house paid off in 20 years. But that's the other piece that financial planners or other folks, advisors are missing. You have that leverage real estate. And as the cost of rents go up, so your mortgage payment might be 2,000 versus rent today at 2,000, for example. In 10 years, your mortgage is still 2,000, rents are 3,000. Now you have $1,000 extra that you would not have that you can invest. Some folks say, well, you know what? My mortgage payment's pretty low. I'm going to make extra payments, double payments. That doesn't do you any good until you sell your home or you refinance your home. So you can take that extra $1,000 a month and invest it. Now, what I say to people is don't pay down your mortgage. Take that money and invest it. But if you're going to go to Vegas once a year and you're going to blow that money, or you're going to go buy some toys that you really don't need, or take extravagant vacations, then maybe pay down your mortgage because it creates a discipline. And that's what you're alluding to, Rich, when we talk to people that have these great plans and, 5-7 years later, they're no better off and they didn't do that investment strategy that they initially thought they were going to do. It's because of you have that extra money and you just think that, going to go, do things that you probably don't necessarily make sense. It doesn't mean not enjoy life and go have some funds, but within moderation.
Yeah, and the average person just isn't a diligent, systematic, every month dollar cost averaging investor, because life happens too. Field trip pops up for your kid. Field trips are, here we go, side quest. But I just had to pay $560 to do a field trip with my kid and to take a couple of days off work and be the chaperone, right? How many people can suck up that kind of cost? So if you every month you're putting $1,000 into your investments and then a $500 field trip pops up, well, you still putting $1,000 in, or did you skip that for the month and use that money for the field trip? And then next month the braces hit, and then next month somebody breaks their leg, and so you just can't avoid making your mortgage payment. You shy of catastrophic events, you're going to keep making that payment and keep a roof over your kid's head. But your stock investments just feel optional to most people. And behaviorally, it's easy for that money to go somewhere else. So the home investment potential is not just the leverage, getting 5 times leverage on, you buy a $500,000 house for $100,000, you now are getting a 5 times leverage on your returns, but you're also getting in my opinion, 100% leverage on your behavior. And this isn't to call people out as being bad with their money. Life just happens and money, has to go where it goes. The home makes sure that you are consistently investing at least in that asset. And that is a huge hedge. And I think, by the way, in defense of Ramsey, that's why he says pay off your house, because he is making a behavioral assumption that most people will not take the difference and invest it. So they would be better off putting it in their house so that money doesn't just get spent on, dinners out and cocktails than the other. And so and from
Yeah.
that perspective, from a behavioral, component, he might have an argument to make. But if you can be slightly more diligent than Ramsey's giving you credit for, you can have massive, massive financial returns in your life by not paying off your home and investing the difference.
Right. It'd be interesting, Rich. And one of the things that just pops to mind is thinking about folks. Will folks invest extra residual income? Like, will they actually invest it? And I think about folks that, you take two people, self-employed individual, someone that works for an employer that participates in a 401k, they make the same money. Does that, you're forced, or it's natural, becomes part of your behavior. That just comes out of your check. You're not necessarily investing that money yourself. You're not making you make a conscious decision to sign up for the company 401k,
Yeah,
and
to check that
hopefully
box
there's
and elect it. Yeah.
yeah, and hopefully there's an employer match there, and you're getting more on your return, versus the other individual that is forced. Folks like you and I, self-employed, we have to make the conscious decision: are we going to do a SEP IRA? How much do we put into that? That's something that most folks, they don't want to part with their money, and they don't necessarily invest it, and they feel like they have more disposable income to spend.
Yeah, and it forces you to a decision. What kind of a financial year did I have? What does the market look like for next year? What kind of a year am I going to have next year? Am I going to part with that money for investment, or going to keep that as an emergency fund or a hedge against income fluctuations when you're an entrepreneur, like we are? Your income is not the same every month. And so, yeah, it becomes a harder choice to invest, but it's really never, I mean, I don't know about the rest of you, but my mortgage is on auto pay. It just happens, right? That
Right.
investment
Yep.
happens every month, which is a great thing to do with your stock investments. This is not financial advice, talk to your own advisor, but that's a great thing to do with your stock investing. If you do want to be diligent, is put it on automatic. But fundamentally, history has borne out that most people, I had a friend who worked in life insurance in New York City forever, a mutual client of ours, Dave, and he would find that basically until late 40s, early 50s, people hadn't done any investing, and then they panic, and then they start trying to backfill and do everything they can to get ready for retirement. And the thing that saved all of those people was their real estate investments, because they'd done nothing else up until that point. So I think the takeaway here is that the claim that real estate is your biggest investment or your best investment, maybe on the dollars and cents, it's not exactly the best. Maybe you could do better in the stock market, but I think behaviorally, you probably won't. And it has the other tangential benefits, which we've talked about: the living in it, the hedge against inflation. And then, I think we can drop into sort of the other things that housing brings to the table, and how Dave and I, well, I won't speak for Dave, how I prefer people to frame their thinking around these things. I think you are better off, and you will make a higher quality decision. And this is a big call, but stick with me. I think you'll make a higher quality decision about the home you're going to purchase for your family if you take the investment perspective and the what money I'll earn on it as the icing on the cake, as the cherry on top. And everything else, the fact that it's a hedge against inflation, and all the emotional benefits of it, are the real reason. So if you meet our 5 real estate fundamentals, and I'll link to that video at the end, you should watch that. If you meet those, then worrying about interest rates or what the price of the house is now or how much money you're going to make on it down the road doesn't matter. If you meet the 5 real estate fundamentals, then this is the way you should be picking your house. Is it going to be a good hub of my life? Is it going to serve my needs for my children? Is it going to be a place I can move my aging parents into? Or when my adult children come home because the world is bananas and they can't afford it, is it going to be a good house for multiple adult families to live in together? Right? Is it going to be in a community that I really love and care about and want to put my stake in the ground and make an investment in the long term? I can tell you, and probably Dave has, I can tell you where I was standing when my wife told us we were pregnant with our first child, right? Like
Yeah.
we went to the store, she went in and took the pregnancy test. I'm still unloading the groceries. I'm standing out the front door and I hear her scream, Rich, and I can tell you right where I was standing the moment I learned that the most important thing in my life had just happened, that I was going to be a father. I can tell you where I was standing painting the nursery when I got the call that eventually led to the death of my mom. I can show you the picture standing in my home of the day they told me I might have cancer. And I can show you the picture of the party we had when I got the "you actually don't have cancer, just kidding," results from the doctor, right? I can show you where we had the graduation party, for my son from kindergarten, and where we had my dad's 70th birthday party. These places are the hub of our lives. They're the places we make memories. They are the places where we do the most important work of our lives, raising our families. And you can't do that inside a stock portfolio. And I think the world has gotten to a place where there is so much financial noise out there that people are trying to convince you that none of that matters. And you need to look at every decision in your life as a dollar and cents decision. And I think it's more important to look at money as something that enhances your life, not as a goal or focus of your life. And if you apply that filter to your house, I think you'll choose a better house. You'll be happier with your decision. And at the end of the road, I think you're still going to make a lot of money and be happy. But that wasn't the point, and that wasn't the decision-making matrix. Now I'll punt it over to Dave for his opinion after my rant.
Yeah, no, Rich, I agree with all those, intangible values of owning a home. And, I think, and even beyond some of that stuff is, your kids go to a school, you rent, maybe I know where I live, it's hard to get into the school district, and now you got to move, and now you got to uproot your kids, and they maybe can't go to the same school or be separated from their friends if you can't find another rental in the same district. So there's all kinds of components and benefit. And we always talk about too, Rich, is when you buy a home too, and you may find over time you don't love that home. That's not where you want to make your memories. But if you follow the 5 fundamentals, you have the opportunity to get out. Maybe you convert that to a rental and you leverage it and you go buy somewhere else. You're not, what people want to avoid is, being stuck in a situation. And I don't view that rarely happens. It does happen, but you do have options, and sometimes you got to just wait it out another year or two. But you're not necessarily stuck in that situation. It creates more opportunity for you.
Yeah, and I think that is a great point, which is that if you follow the 5 real estate fundamentals, then all options are open to. And it's the same with stock investing. You can't time the market, but if you follow, the fundamentals that people teach you, buying, again, not financial advice, people, buying low cost index funds, dollar cost averaging over time, automating your investing, just making small investments consistently, then you can see average returns, and average returns over a long period of time make people a lot of money, or at least enough money to live a good life. And it's the same in real estate, but it comes down to the 5 fundamentals. If you're leveraged to the hilt and you have credit card debt up the wazoo, then you shouldn't be taking money and putting in the stock market or real estate, right? You should be getting your financial house in order. And once your financial house is in order, then all of these decisions can be made in ways that are safe, and that you have a hedge and a backup and an emergency fund, and all options are open to you. And if you make a mistake about a stock purchase or purchase the wrong home and want to sell and get out of it, you can do so because you've done it from a stable base.
And I think the other important piece, Rich, is it's not an either or decision. You don't buy a home or rent plus invest. You can buy a home, and maybe you're not investing for the first year after you buy the home. Maybe
or a
you're
few
taking some
years in this
time.
market, realistically.
What's that? How long did you say?
Maybe a few years in this market, since prices are
Right.
so high right now. Yeah.
Right. So, but it may take some time, but it's not an either or decision. And maybe you're buying a home and you're still participating in your employer 401k, or so you're still investing in the market. You're just not taking all your disposable extra income and investing it. You've invested in yourself, all the reasons why you said in buying real estate. And I'm pretty confident, and it's always kind of mapped out over time. Fixed rate mortgage, 30-year, it's not going to change. Principal and interest, that will stay the same over time. Look historically, rent charts. If you stay there long enough, rents will be significantly higher than what you could, pay for your mortgage. And I say this all the time, which is another piece that people miss. I probably couldn't buy in my neighborhood today.
Yeah.
Right? Like, everybody says that. I couldn't buy this house today, but because psychologically I bought it so long ago, I've stayed here, I've created all the memories that Rich is talking about, but I've used that leverage to get to where I'm at. But someone's got to start at, you start at some point. What's your starting point?
Yeah, and someone will light us up in the comments down below, guaranteed, saying, well, where I live, it's so expensive, it makes more sense to rent. Yep, you're probably right. If you live in Manhattan and you're faced with the highest real estate prices in the country, essentially in old aging buildings with aging infrastructure, where the shadow costs are going to be even higher on top of having spent the most money anybody in the country is spending for real estate, it might make sense to rent a house and invest the difference in Manhattan. Highest, cost area in California, Santa Barbara. Maybe it might make sense for you to rent and invest the difference in Santa Barbara. That's why we say all the time, there's no blanket real estate advice that's good real estate advice. Real estate is hyper personal, hyper local. If you called us from Manhattan, we ran a rent versus own calculation for you and said, man, it makes far and away more sense to rent and invest difference. Go ahead and make that choice for your family. That's why episodes like this are important to frame your thinking around. Don't focus on real estate appreciation, focus on the leverage. That's where you're earning your money. Focus on the hedge against rents going up. Focus on not paying that down, but using any extra money you get to then invest in the market. Do a real calculation, calculating the shadow costs and your overall return of investment. Do a real calculation with clear eyes and deciding your situation is real estate best for your family or not. Just don't discount the psychological and emotional power of just having something you own to house your family. If you haven't done it yet, and especially once you have kids, at least it shifted for me. I don't know about for you, Dave, but there is just a big emotional benefit of feeling like, hey, I've got this roof over their heads. They're safe. I've provided for them. It's at a price I can afford. I can hold on to this. I can house my family moving forward. That matters a lot to me more than any kind of financial benefits I get from my house, especially once you start having a family. So factor in things that don't have a financial equivalent, I guess.
Yeah, I agree with you, Rich. And my kids are a little bit older now. And there's been a couple times where we've said to the kids, hey, you guys want to move? No, we love our house. This is our home. They love their bedroom, and I'm
Yeah.
like, okay, well, we could move somewhere maybe that's, got a big swimming pool or this or that. No, 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 we like it here. And that to me, that's super rewarding. Like, wow,
Yeah.
okay. Unless you give them the opportunity, they're not just going to randomly walk up to you at the kitchen table and say, I love my home, but you say, hey, you want to move, or, they get attached to their bedroom. They get attached to the things that you talked about earlier. So,
Yeah, absolutely. And I think that's a great place to wrap it there, folks. The point of this episode is, yeah, if people are telling you real estate's not your primary investment, they're not, or your biggest, best investment, they're not wrong, but there's more nuance to it than that. So take the whole picture into account, make the best choice you can for your family. Those decisions are above our pay grade. We're just here to help you think about it. If you've made it this far, 32 minutes, listening to Dave and I prattle on and tell stories about our real estate history, you are either a glutton for punishment or deeply dedicated to your financial education. Either way, we appreciate you being here. Thanks for watching. We'll see you on the next one. I'm Rich Curtis.
and I'm Dave Miller. Thanks, Rich.
Bye, everyone. Thanks, Dave.